has been a very good year for stocks in general. S&P up 9% year to date, but it hasn't been a good year for the healthcare sector. The biopharma companies are struggling to adapt to the Trump administration, especially the Department of Health and Human Services under RFK Jr. They don't like the presidential browbeating on drug prices with the prospect of tariffs on pharmaceuticals either. Sell. Meanwhile, the managed care sector is in shambles as people are simply getting much more health care than they're used to, and their insurance companies haven't been charging them enough. But tonight I want to talk to you about one of the rare healthcare stocks that's proven to be a port in the storm, and it is a shocker, people. It is CVS Health. Yeah, the drugstore chain with a pharmacy benefit manager, Caremark, and a managed care business, Aetna. This has been the best performer, get this, in the healthcare sector in the S&P. It's up more than 58% for the year. How the heck did CVS pull that off? All right, now some of this because CVS has become the last man standing in the retail pharmacy space as its last major rival, Walgreens, is set to be taken private and plans to close hundreds of stores in the process, while Rite Aid suffering through its second bankruptcy by shrinking beyond all recognition. But some of it's simply because the stock of CVS already got pulverized last year. It was down 43%. You know, it was the 10th worst performer in the S&P. The problem came from Aetna, their managed care business, which was crushed by all the things that have wrecked the healthcare industry stocks this year. Specifically, the prices were too low in a world of higher than expected medical costs, especially with their Medicare Advantage plans. So in other words, what they did really bad last year is what some other companies are doing this year. Now, I bring that up because I have to, because this year, CVS is finally seeing a turnaround from the managed care side of the business. Now, it's not a great performance, but it's definitely a better one. When CVS reported at the end of July, their healthcare benefits division, which houses the managed care business, saw nearly 12% revenue growth, with operating income up almost 40% year over year. Basically, the health insurance side is doing much, much better. That's an index where lower, by the way, is better. CVS acknowledged that medical utilization rates remain elevated, but the company's finally getting its arms around the issue. CVS medical benefits ratio, which measures the cost of care as a percentage of total premiums received, clocked in at 89.9%. Now, that was up 30 basis points a year over year, but it was a full 80 basis points lower than Wall Street was expecting. Crucially, that number included a large, quote, premium deficiency reserve charge that the company took to reflect higher utilization trends, and it covers their anticipated Medicare Advantage losses through the rest of the year. What a sloppy thing, but they all had to go through this. And that was only one part of overall, though, was a great quarter from CVS versus the other companies in the cohort. And that's something, therefore, that sent the stock soaring over the past month. The drugstore chain posted substantially higher than expected revenue, with all three of their businesses, the pharmacy, the benefits manager, and the managed care division, coming in ahead of expectations. So on top of that, CVS posted a phenomenal 35-cent earnings beat off a $1.46 basis. Since then, the stock's rallied from the high 50s to the low 70s. It's cut more, I think. I don't think it's done. Now, this represents a major transformation for CVS. Now, I want you to keep in mind, last year, management had to cut their full-year forecast multiple times, driving investors crazy, forcing many to abandon the stock along the way. But for the second consecutive year, CVS raised its full-year forecast, and this was a huge raise. They took the revenue guidance up by nearly $9 billion. Wow. And they boosted their full-year earnings outlook by 25 cents at the midpoint. And it's not just because their health insurance business has managed to stem the bleeding. The drugstore and the pharmacy benefits manager are also doing great. The health service division, which includes the Caremark PBM business and the in-store medical clinics, put up a 10.2% revenue growth. Very strong. As for the drugstore business, do you know that both the front of the store and the pharmacy, it delivered a $1.5 billion revenue beat? Operating income up 7.6% year over year. We haven't seen numbers like this from a drugstore chain in ages. Like I mentioned before, CVS is cleaning up because its main competitors have more or less surrendered. Walgreens is in retrenchment mode as it's being taken private. Rite Aid, or what's left of it, frankly, just filed for bankruptcy again in May, second time. That leaves the field to CVS, which is taking market share like crazy. You know, look, Amazon's in there, but the brick and mortar, these guys are winning. It's especially true on the pharmacy side. Comparable pharmacy sales were up 18% year over year. I don't know about you. I had Rite Aid. They sent me to, when they closed, they sent me to CVS. That's happening all over the country. It is good to be the last man standing. Now, that's something, by the way, you would have known had you watched the Bruce Willis movie of the same name. So from end to end, CVS business is simply doing much better than it was 12 months ago. The sore spot managed care business isn't exactly thriving, but it's much stronger than anticipated and seems to have gotten its arms around the most pressing problem, higher medical utilization rates. Meanwhile, the biggest division, health services, is powering forward as Quick Care Mark continues to perform well, and increasingly powerful pharmacy business is driving surprisingly strong numbers on the drugstore side because CVS no longer has any major rivals. I bring all this up because though the stock's up over 58% for the year, do you know this thing only sells for just 11 times the midpoint of its new full-year earnings forecast? 11. 11. That's ridiculously cheap. But by the way, the company pays a $2.66 annual dividend. Stock sports a bountiful 3.7% yield. You got to hand it to CEO David Joyner, who's done some remarkable work in the first 10 months of the job. I really like this guy. He's sharp. He gets it. He knew where the problems are, quickly addresses them. And some of the other parts of the healthcare that we're working this year, like the medical device space, prices to earnings multiples, they've become really elevated, making the stocks much more risky simply because they've gotten ahead of themselves. That's not a problem here. Last year, CVS's stock was priced like the company was good. Well, I don't want to say go out of business necessarily, but you know what I mean. They had these. The management just kept cutting their full-year forecast over and over and over again. Even though the stock's rebounded substantially from those levels, it's still super cheap now if the numbers are going up higher. I'm clearly not alone in thinking this. By the way, last Monday, analysts at UBS upgraded CVS to a buy following 2 strong consecutive quarters of execution and early signs that the healthcare benefit segment fixes are on track. I feel the same way. Let me give you the bottom line here in this very exciting story. Healthcare has been horrendous this year, but CVS, one of the worst performers in the entire market in 2024, you need that preface, has proven to be a port and storm for healthcare investors. It is up 58%, leads the entire cohort, fixing its most problematic business, managed care, and seeing real strength in other parts of the business, especially the pharmacy side, where it is the last man standing. Plus, given the cheapness of the stock, generosity of the dividend yield, here's what I'm saying. Buy CVS. Summer in Connecticut. It is summer in Connecticut. Summer in Connecticut.
Hey, Jim, it's Sumner. Hey, this stock's
Sumner, how you doing?
How you doing? Yeah, not a problem. Right. The stock's down 40% on the year. It looks like it's stabilizing with the likes of Warren Buffett buying it. Do you think now is a good time to start a position in UNH? Go Birds. Okay,
so I have these rules which say don't buy one of these things because it's done. It looks like it's done a lot of things wrong. That Buffett does not. The fact that they're buying it doesn't influence me. What I want to hear is from the company. The company comes on the show, tells the right story. I will be behind it, lock, stock, and barrel. But they got to come on, and they got to answer the tough questions. Plain and simple. That's what you want. That's what I promise. The turnaround at CVS is well underway, and given how cheap it is, that generous dividend, I bet this name has more room to run. Watch where I made money. I include my sit down. Oh boy, this is going to be terrific. With Pitney Bowes PPI, it's the global mailing and shipping company. Midst of a major transformation. I'm getting firsthand account of the turnaround here with the company's top brass. I got to tell you something. There may be something here too. Long knives out for the federal government's deal with Intel, but I'll break down why I think this was an intelligent investment by the Trump administration that's also good for shareholders of Intel. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.